Welcome to another episode of Simply Bitcoin IRL. I have the one, the only, one of the macro heavyweights. There's so many. There's Greg Foss, there's Jeff Ross, there is James Lavish, there is, just had him on the show, Lawrence Lepard. You're one of them. Definitely want to follow this man if you want to know what's going on in clown world, because there's some pretty crazy stuff happening as of late. To preface our conversation, Sailor actually tweeted something out very interesting, and I want to pull it up. I want to read it, and then I want to get your thoughts, James. So let's check it out. The tweet by Sailor said, if you flew an aircraft like this, you would stall, rip the wings, crash and burn. Luckily for us, it's not the trajectory of a flight vehicle, but rather the U.S. Treasury, U.S. one-year Treasury, the risk-free interest rate diving the entire $500 trillion global finance system. So a couple things to talk about, right? Why?
Well, first of all, thank you for having me. And Nico, I appreciate being on here. And thank you for putting me in that incredible group of brains. I'm not sure that I deserve that, but thank you. Yeah, I saw that post. He's right. It's absolute insanity the way that we lowered rates down to zero and then ripped them straight up. And what people, for people who are wondering what we're talking about, that was the Fed funds rate that he was quoting there, right? So, what happens to debt markets when you do that is it shocks them. It shocks the markets. And we're starting to see the repercussions of that around the world. The Fed leads for people who are kind of armchair investors or not really in this world. Just to give you an idea, the Fed leads the policy, the monetary policy of the world. And what I mean by that is that when they set rates, everybody has to kind of react to them, right? So because we're on the U.S. Treasury reserve asset, the global reserve asset, people need dollars to pay for things. There's a massive amount of dollar denominated debt around the world. The euro dollar system, any country who can't issue debt in their own currency, they usually do it in dollars, and so they need dollars. And when the Treasury goes up in interest rates, when the interest rate in the Treasury goes up, and we'll talk about the 10-year, because that's kind of the benchmark. When that interest rate goes up, then any other country that is trying to pay for things in dollars, if they've got dollar denominated debt, they have to use dollars to pay back that debt, right? So the problem is what we quickly get into, what we're seeing in Japan in particular, is you get into what's called interest rate parity. And what that means is, and basically is that if our interest rates are higher than another country's, then the investor in that other country is likely to sell those treasuries that they're invested in and buy U.S. treasuries. Well, in order to do that, you sell your treasury, then you get whatever currency you're denominated in, you sell that currency and you buy the dollar. So that's why you're seeing the dollar go straight up. And you're hearing of problems in Japan and in UK in particular. But the issue is that, as we lead the world and we rip these rates higher, we're seeing pain. We're just doling out pain to everyone around us. And we're going to start to see that pain in our markets now. We're starting to see some hints of it in the treasury market. I've posted some things about it. I'm going to post something again tomorrow morning, a thread about it. We're starting to see, I wouldn't say cracks here in the United States, but we're starting to see inklings of illiquidity, and that's an issue. So I'll pause there because that's a long explanation, but yeah, that's kind of where we're at the moment.
So you said something that I picked up on, And I think that, so we're not out of the woods yet. Things
no.
but are things breaking? Is that what we're witnessing? Why is it happening so slowly?
All right, well, let's talk about Japan. So what we're seeing in Japan, and we've talked about this.
Also, James, sorry
Yeah.
to cut you off. Your audio,
Yeah.
your audio's coming in a little weird.
Is it really? Is that better? No.
No.
Okay, hold on. We're gonna see if I can switch my audio to. Just bear with.
For anybody who's tuning in, this is Simply Bitcoin IRL. We have James Lavish. How about now?
All right. Is that any better? No. Is that any better?
Coming in a little distorted. I don't know what's going on.
Distorted.
You know what? You know what sometimes fixes it if you lower the resolution of the video.
Really?
Yeah, might be a bandwidth.
A bandwidth problem. All right,
Yeah.
hold on. Let's see. Is this any better?
Yes, it is.
All right, cool. A bandwidth problem. Sorry about that. So I'm a little bit away from my server here. I got to fix that. Anyway, so what were we saying? Oh, Japan. Is the audio? How's the audio now? Because I think I turned it up. Cool.
It's good, guys. Let me know in the chat if the audio isn't coming in good.
All right. Anyway, as you were. So okay. So the problem in Japan is, okay, so the Bank of Japan they've been holding their rates steady on their 10-year government bond, right? The JGBs, right? And what they've done is they've said that their 10-year treasury, they're going to hold at 0.25%. They're going to buy every bond they have to in order to keep it at 0.25%. That's called yield curve control. And they're doing that because they want to spur inflation there, right? So they want the rates low because they want people to be investing and borrowing to invest, right? So, okay. So what happens? Well, if you're a Japanese investor and you've got those investments, then you're going to be selling your treasuries and your Japanese treasuries, and you're going to get yen. You're going to sell the yen. You're going to buy the dollar. So you're seeing that the yen moved 30% in just a couple of months here, which is just insane. It's insanity. So it's breaking their market, right? So what happens is they're now having to come in and intervene. The Bank of Japan is intervening by buying yen and selling dollars. They have a certain amount of dollars, I think $100 billion worth that they're holding that they can use. But beyond that, they have to start selling treasuries, and that's where it starts getting dicey for us. So that's the issue there. And then you're seeing it in Italy, and you're seeing it.
Yep.
Yeah.
I have a question, James. Are you using
Sure.
Google Chrome by any chance?
I am. Should I switch?
No, that's the good one. Try exiting, coming back, and see if that fixes it.
Oh man, I'm sorry, man. Okay.
No, it's
okay,
all good. It's all good.
Okay.
We'll keep it going.
I'll be back.
Sounds good.
All
right, guys, you're listening to Simply Bitcoin IRL. Once again, 2 for 2. We are having some technical difficulties. Same thing happened with Tone last week. Restream apparently sometimes isn't friendly. James will be right back. We'll go down. We'll continue going down the macro rabbit hole. So yeah, I think Opti's here. So Opti, I'm gonna put you on the spot. Hey, bro.
What's up, everyone?
Oh man, dude, the audio technical difficulties, bro.
Yeah, and you ninja launched a little early today.
No, I told everybody on Twitter.
Oh, apparently I'm not on Twitter. Anyways, I think you need to give your producer a little more heads up, bro.
I know. I'm
I'm the only one that didn't know.
Oh man. Well,
we got the spaces going. I got it running.
Yep.
So hopefully we get James back in here.
We get James back in here, and we take it. Opti, tell us sweet nothings. You got a request.
Sweet nothings. What's up, everyone? I don't know why I'm on here. I am supposed to be the producer here, but glad to be here. I am excited for this one. I am running 5 minutes late, apparently, because
we're holding down the fort until James
holding
comes
down
back.
the fort.
We'll edit this.
How about TLD Army? What did I miss?
He started talking about the yields, man, and how things was breaking, and the conversation was honestly about to get very fucking interesting.
Yikes.
the audio did its thing. So yeah. Anyways, but I'm really again, I look, I don't understand finance like, you know, a lot of these heavyweights do, but I've been in Bitcoin long enough to understand that things are breaking. It's very obvious, and I think that Clown World is also accelerating as things are breaking. You know, so oh man, it's gonna get interesting. Hopefully we can get James back in here and he can explain to us what is going on. So just bear with us, guys.
Yeah, and if worse comes to worse, just tell him to lower his bandwidth a little bit.
Yeah, that's what I did. Hey. All right. So bear with us, ladies and gentlemen.
Hold on, I think I got the sounds loaded up for you, Nico. In the meantime, 1 second.
I think he's definitely trying to fix his internet.
He's on the YouTube, it says, and he's in the YouTube chat.
Oh, James, I'm here. No, that's the wrong James. Oh man. Bro, the internet. Let's go, padres. If you're joining us, give us a second. We're having some technical difficulties. All right. Oh man. All right, Opti. Let's keep everybody entertained. Oh, here we go.
He is.
Oh, James is back. How you doing, James?
Sorry about that.
Oh, good.
So
Yes.
is it any better?
It's working. Oh man, I'm very happy. Okay, we're gonna start it off from right here. I'm gonna edit it after the fact. If for anybody tuning in right now, welcome to another episode of Simply Bitcoin IRL. I have the man, the myth, the legend, James Lavish. He is one of the macro heavyweights. And we're going to talk about Clown World and how it's breaking ever so slowly. So, James, the last thing that you were talking about before we had a technical interruption, this happened to me 2 weeks in a row. You're talking about the situation in Japan. What is going on in Japan? And more importantly, I think most of us don't live in Japan. I think it's safe to say that. How does this affect us? Why should we care what's going on in Japan?
Yeah. So, well, first of all, thank you for having me again. Sorry about that. I don't know what's going on, but let me know if it doesn't work. So the bottom line is what's going on with Japan. Well, what you were talking about is the post from Michael Saylor that he said, you know, he had the post of the Fed funds rate, and if we had if this was an airplane taking off at this rate, that the wings would rip off and it would destroy the aircraft, and you know, so and it's the same thing, you know, the thing rates so dramatically, so quickly. It's not just the amount, it's the percentage of interest rate, right? So it's you know, 1% is like we were at 0.25%. So just raising it 75 basis points is raising it 300%. So like we're raising it so rapidly, and it's causing some shocks around the debt world, and you can see it in places like Japan. So for instance, and so what we were talking about is interest rate parity, where Japan is instituting what's called yield curve control, and yield curve control is when the government intervenes and manipulates the yield curve. And so what they're doing is they're buying their 10-year treasury and keeping it at 0.25%. The problem is, as we raise rates and they do nothing, then you have this arbitrage between the interest rates, and it's called interest rate parity. And so people are selling the Japanese bonds and buying the U.S. Treasury in order to capture the better rate here, because instead of getting 0.25%, they get 4% here on our 10-year. So that's what they're doing. And when they do that, they're in turn, they sell their Japanese treasuries, they get yen, they turn the yen into dollars, and then they buy the US Treasury. But the issue is you're seeing the yen just explode upwards, and that's the number of yen per dollar. So it's really bad for the yen. It's up almost 30%, meaning it's down 30%, and it's weakening, and that's hurting the Japanese economy now. And they're starting to get surveys back from Japanese manufacturers, and they're like, it's an issue for us to have such a weak yen. So why does that matter? Well, it's just showing what the power of the U.S. dollar and the U.S. Treasury, and what the kind of pain that we're instituting. And the same thing is happening in Italy. So what's occurring there is the same thing. You're seeing the 10-year Treasury in Italy start to track away German 10-year as the U.S. 10-year goes up in interest rate. And so that spread just gets wider. And so again, you've got another central bank, and this time it's the ECB. And the ECB is stepping in, and they're buying the Italian treasuries, or they're standing there ready to buy them if they have to. Nobody really knows if they have yet, but that's the idea. So then they go in and they buy those and manipulate that yield curve. And then you saw that what was happening with the British pound. Well, the British pound started falling against the dollar, because again, we're raising rates while everybody else is kind of staying dormant, or they're way behind us. So as they're doing that, and their government then shocks the market with a tax cut that everybody's like, there's no way you can pay this tax cut with interest rates going up. And and so their bond market collapsed, which pushed a number of their pension funds right to the edge, because they were using these liability instruments that were that are basically just a massive amount of leverage in order to get returns to meet their liabilities for their pensions to pay out. And so they're just leveraging up their balance sheet on these tiny interest rates, hoping that it works. And of course, it didn't work. So the Bank of England has to step in and save that market. So the whole point is that it's showing the cracks of the debt market, the massive amount of debt that is around the world. It's almost 4-to-1 debt to GDP around the world. And you're just seeing all the cracks in the system. You're not seeing them here in the United States yet. But you're seeing the repercussions of our actions and what that's doing, and what it's causing the rest of the world to scramble for dollars, because, as we were saying before we got cut off, there's a massive amount of U.S. dollar denominated debt around the world, whether it's in euro dollars or it's in just U.S. dollar denominated debt with countries that can't issue bonds in their own currency because it's not strong enough. And so they scramble for dollars, and those dollars get more expensive. It just feeds on itself, and their currency gets weaker, and it's a total mess. So what are we doing? Well, you saw what happened with Switzerland just the other day. They opened up a swap line, and they took out billions of dollars on a swap line with the Fed to borrow U.S. dollars. It's just, we're starting to see the issues that are manifesting themselves. Well, not themselves. They're being manifested by the problematic system that we're living in. It's a debt-laden system. We are absolutely in a debt spiral in this world. What
does that mean? What does that mean, James, when you say debt spiral?
Yeah. So I talked about this recently, and basically the debt spiral is just when you look at the United States, and this is what all this is. People are coming back and looking at the United States balance sheet, and they're starting to get concerned. Now, before we go any further, like the U.S. Treasury is the reserve asset of the world. So if it fails, it is like Armageddon. Like the whole system collapses. So just put that over there for a second. But if you look at the United States and you just consider it like a company, right? And you try to figure out, well, how strong is this company? It's got a lot of debt. It's got $31 trillion of debt. Wow, that's a big number. Like, what does it mean though? Okay. So if you look at you just look at the debt to GDP number, right? It's 137% because our $31 trillion over just over $24 trillion of GDP. That's a large number. Okay. So I've heard Lynn Alden say that there's no country that ever survived without going through some sort of restructuring or default on their debt, being over 130% debt to GDP. Now, we're the U.S. We print dollars. We've been doing it, ad nauseum for the last number of years, and so there's also a statistic that countries that print their own money don't hyperinflate. So just put that there. Okay, but going back to just looking at the health of the United States, well, okay, we take in, let's drill down a little bit. Like how well can we cover that interest payment on that $31 trillion? Because the interest payment is $400 billion a year right now, and that's going up. That's quickly going up to $700 billion. Okay, but today, if you look at the Congressional Budget Office, the CBO, these are their numbers. They're published. They're as rich you can get them, because they think that they can just keep spending money, and this is what their budget looks like, and all is good, right? And if you look at their sheets, it says that they expect $4.8 trillion of taxes this year. That's going lower. We know that. Why? Because the economy is going into a downturn. The market is down 20 some odd percent on average. So you're going to get lower capital gains taxes. You're going to have lower individual and corporate taxes because margins are coming down as interest rates go up. It's clear that the taxes are going to go lower. Okay. Then you've got your mandatory expenses. Okay, so that's your revenue line, your taxes. That's how much money we make as a country, $4.8 trillion. Okay, and that's optimistic. Then if you look at our expenses, the expenses that are signed into legislation, the ones that we have to pay, those are the entitlements: your Social Security, your Medicare, your Medicaid, okay, and a few others. But it's $3.7 trillion of expenses there, just in entitlements. Then you've got defense contracts. Okay, so we have these contracts that we've signed that we've got to pay these defense contractors to make all the equipment that we're sending overseas. Okay, so that's $800 billion, because that leaves you with $300 billion for interest. So remember, $4.8 trillion of taxes of revenue, minus 3.7, minus 800, minus 300. That leaves you with $300 billion to pay the $400 billion interest expense. So we're under a one time, right now, today. Okay, so we can't pay our interest expense. So what do you have to do? You have to issue more debt. Okay, but those taxes are going lower. The entitlements are going up. We just had a $300 billion student loan forgiveness plan. So that's got to be paid for. And what about the so-called Inflation Reduction Act? That's going to be paid for. These are not in these numbers, right? So it's funny, but it's not funny. So This is what it is. So let's just think about that. You have to make that up by issuing more debt. Put it this way: and this is the example I've been giving, is that, look, if you're a single parent and you're struggling, you've got your mandatory expenses. You've got your mortgage, your car payment, you've got your food for you and your kids. Like, those are, like, you have to pay those things. And if your two jobs don't pay for that because inflation is going up, it's difficult right now, what do? Well, you're going to charge some stuff on the credit card. You're going to charge some meals on the credit card. You're going to charge your groceries on the credit card. You're going to charge your gas on the credit card. Okay, so now what do? Well, your credit card expenses are going to be high. And so that's going to eat into your already negative deficit. You're in a deficit. So your negative earnings are going to be eaten into by those higher credit card payments. So eventually, what are you going to do? You're going to take out another credit card and you're going to run that up. And then eventually you're going to take out another credit card. But the problem is now your credit's going lower. Your credit score is going lower. So the interest payments are going to go higher because the interest rate on that new credit card is going to be higher because you're higher risk. And this is what's happening around the world. And it's going to happen here in some way at some day. It will be the last to fail, but this is where we're at. So what do? Well, that's called a debt spiral. That is, and there's no way out. You can't keep it up. Why does it matter so much today? Well, we're in a rising interest rate environment. Okay, we have a third of our debt that matures in about 18 months, and about half it matures in roughly 4 years. Right? And if we've got our interest rate right now, so think about it. You've got your interest expense is $400 billion. Right? So it's about 1.3% ish for your average interest rate on your debt. What's the interest rate today? It's 4%. That's on the 10-year. And they're talking about bringing us up to 5.5%. I mean, so 5% on $31 trillion of debt. It doesn't take a math genius to see that this doesn't work. Okay, so they know this. So what can they do? Well, they need to raise rates super fast. And this is what Michael is showing. They know they need to raise them super fast, crush demand, because this is a supply side issue as well. It's not just demand issue, it's a supply side issue. So, but they're going to crush demand. They're going to put people out of jobs. They're going to, the unemployment is going to go up. Housing is going to get crushed. Borrowing is going to go lower. And then, then they'll be able to pause and take the rates down in the next, I'd say by 2024, they're lowering rates. And because they cannot refinance at 5%. The debt will be gargantuan so quickly if we do that. So it's not likely. So what are we going to do? We're going to pivot and then we'll resume QE with, when we're in a recession. That's my base target. Now look, let me back up a second. This is what I believe with a high degree of confidence. I'm not saying this is definitely going to happen, but if I look at probabilities, this is the thing that's most likely to happen in my view, in Luke Groman's view, in Larry Lepard's view. We've talked about these things. This is the most likely thing to happen. Does it happen like this? I don't know. But as an investor, all you can do is attach probabilities to things and position yourself that way, right? So that's the way I'm looking at it. Sorry, I cut you off.
No. So first of all, I really appreciate it because you're blowing my mind right now. And again, I don't have the background you do. I tell all you guys this. I skipped the whole traditional financial world and I went straight to Bitcoin. And now I'm learning backwards. And I'm just like in awe, like, holy crap. Like, I can't believe this is how things work. But I'm seeing the same thing. I'm seeing the same thing you're seeing. And I think you're right. I think it's going to be catastrophic. And someone asked a really interesting question in the chat. And I asked that same question to Lawrence a couple weeks ago. What will this look like? Because it's funny because Foss told me the same thing. Lawrence told me the same thing. You're telling me the same thing. Ross told me the same thing. So what will this world look like? Here, Z-Logic says it perfectly. I'll ask his question. It says, what will be the consequences of the coming restructuring?
Well, which restructuring are we talking about? We're talking about taking the whole restructuring of the United States debt and our monetary system. I don't look. What I hope, what all of us should hope, is that the U.S. Treasury becomes unseated as the global reserve asset. It will, okay? But what we hope is that it becomes unseated in kind of a whimper. We don't want it to crash. We don't want an implosion. We want Bitcoin to gain enough traction, get enough confidence in it, have enough value in it. The market value has to be massive. It's got to start absorbing the store of value, gold and silver. It's got to start absorbing some of the risk assets and equities. It's got to start absorbing the speculative investments in real estate. It's got to start absorbing bonds. And once it starts absorbing bonds, well, that's when it's at the level that it is an absolute, it is a portion of your portfolio that is a separate asset class. And once it's there, then it can be a reserve asset, and it'll be worth millions. I mean, it's just pure math. It's simple math. But there's nothing out there that can do this. You might have we're hearing that the BRICS is coming together, Brazil, Russia, India, Saudi Arabia, and China. The thing is, do they use Bitcoin? Do they use gold? They're not using treasuries. That they're looking to have a reserve asset that's non-US Treasury. They're sick of being beholden to the Treasury. China can't really do much about it right now because our trade relationship is so it's so integral to their economy. But they're looking for something. Gold it's too easy to manipulate with the paper market. So, but I could see some sort of mix of gold and Bitcoin, and then eventually just Bitcoin. It's just the future. And whether that happens in my lifetime, I'm 50 years old. If that happens in my lifetime, I wouldn't be surprised. I wouldn't be shocked. But I would be surprised if things don't start coming apart. Like, I would be surprised if Europe makes it in the Eurozone, if it makes it through this decade. And I can't imagine that it will, not with what's going on. I would be surprised if Japan doesn't have sort of reset, some sort of massive monetary reset. And that will affect everybody. Those are G7 zones. So, those are going to affect everybody. So I hope that helps. Yeah,
it does. And it gives, I'm coming up with even more questions. Why did all this happen? Was this avoidable? Was this due to bad central bank policy?
Well, it's a system, right? So look, we can't, you can point back to the Bretton Woods and the exit from gold as a reserve asset. You could point to that, and inflation and debt. But the truth is, and here the fair thing is, the truth, a fair diagnosis of this is, we couldn't have grown so quickly without debt. You're borrowing on future productivity. You're borrowing against that. And so we're able to, really drive a lot of innovation and productivity by all this debt. But we got ahead of ourselves, and our big mistake, our huge mistake, in my mind, what started back in 1987. When Greenspan stepped in and said, "Oh, we're going to make sure that the market doesn't collapse," and then you flash forward, you go to 2008 and Bernanke. We didn't let the system absorb enough of the shock. We didn't let some of the bad actors and massive leeches of this world fail, and we should have. We should have let some more banks fail. We should have taken in more pain, and we should have just suffered a little bit for that. Because what we did do is we set it up to roll into 2020 with the inability to absorb any pain because the debt had already skyrocketed. And now look at us. There's nowhere to kick it any further, right? So I think Larry's the one who likes to say this, is that, look, we kicked the debt failure the default from the banks up to the sovereigns in 2008. And now here we are, and maybe it was Luke Roman saying this, but now here we are in 2022. Who's going to save us? I mean, who's going to come in and kick the can down the road for us? It's not. I mean, unless aliens land on our planet and they're like, oh yeah, well, don't worry, we got central banks too. I mean, like, there's no place to put it. So there's going to be fails, and so the dollar will swallow just about every other thing in its path until it can swallow no more and people lose confidence in it completely. And I don't know when that happens, but we're on that path, and we're going to print again. We have to, and so here's why. Let me put it into simple terms for your viewers. With all that debt, the way out of it, and you saw this back in World War II, and this is something that Lynn talks about quite a bit, but the way we got out of that was by super high inflation. Okay, so we keep talking about how we're gonna crush inflation. It's gonna go back to 2%. No, it's not. It's not. It may. Now that's something I have extraordinary confidence in, that we are not going to a regular 2% inflation rate again. We can't. We've got to inflate this debt away. How do you do that? You let GDP grow in nominal terms, okay, with high inflation, so that GDP number goes much higher, right? And it's able to pay down some of that debt that you're inflating it away with these cheaper dollars. So if I lend you $100 today, Nico, you could go buy probably 25 Starbucks with that. Then when you pay me back in 10 years, how many Starbucks can I buy with that? Maybe 10, maybe 5. So it's cheaper dollars because the dollar is worth less. You're making so much more in 10 years than you were today because of inflation. Everything goes up in dollar terms, including wages. So that's the way that they're going to tackle this, is by letting the inflation run a little hot for as long as they need to kind of inflate away these dollars. And eventually people are just going to get sick of it. And that's the rub right there. Eventually people will absolutely get sick of the US using the rest of the world and, tricking them into this shit dollars that they're working their asses off, and 4 to 5% of it gets taken from them every single fucking year. And it's wrong. It's sinister. And that's why I'm here. And that's why we're talking about Bitcoin, because this can be solved with Bitcoin, period.
And it's really interesting, because it's not only foreign countries that are being used by this system. It's really anybody in the lower and the middle classes that don't have the means to save in assets. If they're saving in dollars, perhaps they're not getting as rug pulled as other countries, but they're still getting rug pulled, maybe to a lesser extent, but they're still getting screwed. The only benefactors of this system, from my perspective, are the U.S. government and extremely wealthy people that do have the
extremely
means
wealthy
to save
people
in
have
assets.
large holdings of assets that inflate along with the dollar. I mean, that's it. I mean, your average person now is going to get hurt because the housing market is it's not going to be like 2008, but it's going to go down 20-25% in my mind. I think it's highly likely that it drops 20 to 25%. That's going to hurt a lot of people. They borrowed against their house in order to fix it up. Think about it. You're sitting at home for 2 fucking years. They had us locked down. You're sitting at home, you're working from home. You're like, well, I got to fix up this office. I can't have these Zoom calls in here. I mean, I did it myself, I can't have these Zoom calls in here while I'm, I've got a dog bed behind me. I mean, like, you've got to do some stuff. So you decide, well, I'm going to take out some money. The house is way up, it's fine. I'm just going to remortgage it, take some money out, whatever. And then all of a sudden you look at it and you're like, oh shit, now I own more on the house than it's worth. Luckily it hasn't happened to me because I didn't take out money off the house, but that's what people are going to suffer through. And we are not seeing the credit card debt rise as much as I thought we would yet. And I think I don't know. I'm going to be very interested to see where this shakes out next year in 2023, because people still have money in the bank. And I don't know if they're so worried that credit is going to get pulled from them, that credit cards are going to shut down their accounts, or that something's going to happen, that they want to keep actual cash in the bank that they can draw from while they borrow on credit cards too. I don't know what's going on there, but it's going to be very interesting in the next year to see how this plays out. And unfortunate. I think it's going to be painful for some people. And so be careful.
Oh man. Okay, so James, how does Bitcoin fixes this? How will the lessons of the past not be forgotten once again?
Yeah, well, I don't know if the lessons of the past will not be forgotten. We're stupid humans. We have this herd mentality, that the fact that we trust the government, the fact that so many people just have given up. They're like, oh, well, there's nothing I can do. It's the government. If I say anything, they're going to come after me. And they're probably right. I mean, I don't know. So but at some point, people get tired of it. And so there will come a time where Bitcoin separates itself. It decouples from those risk assets. And that's going to take understanding. We've got to get mainstream media to stop beating on Bitcoin because of because it's boring, or because they call it the leading risk asset, and it's acting like that because of that mentality. It's coupled with risk assets right now. The Greenpeace coming out with those stupid videos and those posts about Bitcoin taking up more energy than whatever. I mean, like, it's insane. And these people have an agenda, and they think for some reason that humans can be productive without using energy. They're fucking delusional, So once we get that's one part, you get the misinformation, disinformation out of the way, and hopefully with legislation that will help. I think that having legislation and declaring Bitcoin a store of value and a commodity, and having it regulated properly, that's going to help. Having an ETF, a spot ETF approved, that will help. That will help small offices. And a lot of people are like, well, nobody deserves it if they can't figure out how to put it in a wallet. Okay, well, I hear you, but if you want this to be adopted, widespread adoption, it's got to be easier. People have to be able to just look at a screen and know that they own it. And if you can buy a spot ETF that is highly regulated, that shows that you own Bitcoin below that if you called it, that there would be Bitcoin attached to that, and you can see in all the wallets exactly where it is, then that's a huge positive. It's going to get family offices involved. It's going to get high net worth people who are just not comfortable with holding their own keys or whatever it may be involved. And that's a huge first step, just to get more capital into the system. And then once you've got five asset managers that control $30 trillion of investment assets. $30 trillion. BlackRock, Fidelity, Vanguard, State Street, and Morgan Stanley. 5 asset managers. Think about that. Now, you've got a couple of them already out announcing that they are involved in Bitcoin, that they have products that the customers can buy it, their investors can buy it. And so that's important. And when it becomes a separate asset class for those 5 institutions, game over. Everybody has to own some. There's just no way around it. That's $30 trillion out of $400 trillion of investment assets in this world. Everybody has to own it, period. So that's going to be a huge development, and that's going to start with understanding. So, I'm out there talking to people that I know that are in the institutional space. They're still way behind, way behind the 8 ball. They have no idea what's going on. They think that it's Ethereum and Bitcoin and Hex and whatever. They're all in the same freaking boat. They don't understand it. They think, oh, well, there'll be a new, better Bitcoin. They just don't get it yet. But when they do, when they finally wake up, they're going to see it. They're going to kick themselves, and they're going to buy it at the price that they deserve. and it's going to be in the hundreds of thousands of dollars, and that's fine by me.
Oh man. So you said something really interesting, James. You mentioned the spot ETF, and I'm actually going to connect this with Catlin Long's bank, Custodia. And it's really interesting because the Federal Reserve, that they're the ones in charge of issuing the federal bank charters, has slow walked Caitlin. It's basically 2 years. She currently has a lawsuit, and also on the ETF front, you also have major lawsuits by a lot of the players, a lot of the specifically Grayscale. Now, what's really interesting though, James, is they've approved futures. So
yeah, of course they have. It's paper. There's no Bitcoin to settle with it. Look, I was actually I was at an event with Michael Saylor a few weeks ago. I talked to him directly about this, and I don't want to quote him, but the point is that, but he's highly confident that once we have regulation around this, that an ETF will get approved, and it'll make it much easier. One of the things that we were talking about, and a big thing, is that FASB report that just came out, because you can't, if you're a company and you own Bitcoin, you have to hold it on your balance sheet at either cost or a loss. You cannot mark to market. So there's no benefit for a company to own it until
that changed. That changed though recently.
Exactly. That's the FASB report. That was a huge plus. So I expect to start seeing some companies start to chip away at it. But I don't know when it gets approved, but there will be enough pressure that a spot ETF will be approved. It will. Gary Gensler I think he is pro Bitcoin, and he understands it. But there's just, look, think about it. Who doesn't want Bitcoin, right? Who doesn't want it?
Governments.
Well, yeah, but they could use it to their advantage. They don't want it because they want CBDC, which they can control completely, and that's a whole nother, can of dog poo. But the who doesn't want it is Jamie Dimon. The major banks don't want it. Why? Because it's disruptive. It's disruptive to their perfect fucking yacht making, model. They don't want to have to give back their planes and yachts. They want to keep making as much money as they possibly can in a system that has absolutely benefited them to no end. That's why. So trust me, they're in there holding it off, saying, that they're definitely in the ears of regulators, making sure that this is slow-footed. That's just what it is. But they're not going to be able to hold it up forever. I don't think that the spot ETF is necessary for Bitcoin to be widespread adopted. I just think it would accelerate it. And I do think that regulation will accelerate it. Of course, the other thing that would accelerate it after, not during, but long after or not very long after, but long after a total collapse of the current system, but you don't think that the Bitcoin won't save you in the middle of a collapse. We don't want a total collapse. That would be absolute calamity. We would rather have this adopted alongside the idiocy, while the idiocy continues to make itself obsolete. That's what we want to happen.
So, James, going back to the macro situation, right? Specifically in the 1970s, there was stagflation, right? High inflation and almost no economic. The stock market literally went sideways for better part of almost a decade. We've been in a macro bull market since 2009. And in fact, all my professional career, that's all I know, right? Since 2009, it's literally been if you look at it, it's literally been a straight line up. Yeah. Not in my lifetime. I don't know what it's like to have a sideways stock market for 10 years. Are we entering that stage? Are we in stagflation already?
I think well, yeah. I mean, as soon as the unemployment numbers go up, I mean, that's really stagflation, where you've got a contraction economically, yet prices are going up. So, do I think that's going to happen? No, I don't. I think that we're going to print. It's not like the 1970s, man. We have so much more debt. It's not that we had 30%, some odd 30% debt to GDP back then. Now we're at 100 and almost 40%. So you're definitely going to have inflation, but I think they're going to have to print. They can't let the economy go into the toilet. They have to make sure the economy doesn't get destroyed. They're trying to save face here. Powell's talking a big game. And I do think they're going to continue raising rates. I don't think they're going to pivot here before the year end. I think they're going to continue raising rates. They're going to continue raising right up until the point where they're about to break something. Well, they got a lot of room in the treasury market still. We got $2.3 trillion of reverse repo money just sloshing around these huge banks every single night. They can do some things, and I put out a post about this. They can do some things. Actually, I'm going to put out a thread about it tomorrow morning. If you don't read my newsletter, I wrote about it, but I'm putting it in a thread form tomorrow morning. You can see it. But there are a few tools they can use in order to combat that, and they're going to use those. And once those are used up, and once you get, unless a shock happens where our treasury market just locks up, then they're going to do these things first, in my opinion, and then they're going to print. Next year they'll pause, they'll pivot, they'll stop their QT. I think that's the first thing they do, which they barely started anyways. They're going to stop selling the treasuries that they have on the Fed's balance sheet, and they're going to step away, and then that's effectively a pivot.
So what's interesting, though, is that if you look at Europe, if you look at the inflation rate in the United States, could they do that with elevated inflation? Could they turn on the money printers? I mean, the answer's already it's already been answered, because the UK did that already, right? They turned on the money printers.
Yeah, they're tightening and loosening at the same time. And I think what Greg Foss likes to say, you can't suck and blow. They're literally doing it. They're literally sucking and blowing at the same time. I mean, they decided to print money to buy gilts at the same time they're raising rates. You can't make this shit up. And so somebody asked in the chat, who? We're talking about the Fed. That's who we're talking about. And the Treasury. The Treasury can play in a role in showing up the Treasury market as well. So
okay. So is this what you mean by things breaking? Is this a scenario? Is this what's happening, right? Where they're stuck in this situation where they don't want the economy to collapse. You have bureaucrats coming out of the woodwork like Elizabeth Warren. Turn on the money printers. You have the UN. Turn on the money printer. You're gonna break people. You're gonna break things.
Turn on the print this. And so no, they're gonna use these tools. They're gonna do what they can, and unless something happens where it locks up before they can institute some of these tools, they're gonna go through them first. They're gonna try to get through that reverse repo money first. That's my opinion. Maybe I'm completely wrong, but that's my opinion. And then I think if it doesn't work, then or that dries up and we still need some more support in the treasury market, well, then they'll print. And like I said, you can print pretty much forever without defaulting until the world loses confidence in your currency.
So it's a confidence game.
Then you can't. Yeah, but the U.S. is going to have we're the safe haven. We are fortunate to be in this position, while Europe is hurting right now. Like the UK is hurting right now. We're gonna feel pain here. Don't like take this the wrong way, but we will not hyperinflate, or we will be the last one to fail. We will absolutely be the last one to fail. There's just everybody's relying on the US to pull it out. Like it's just, and we're going to do this as long as we can. It can happen for a long time, Nico. And that's probably the good thing. It's probably a good thing. And when we come out of this, I do believe that Bitcoin and hard money, gold and Bitcoin are going to rip, and Bitcoin will be in the hundreds of thousands of dollars. There's just no way around it, and eventually the millions. That's what I believe.
So I was talking to Lawrence a couple weeks ago about the fourth turning theory. Are you familiar with it?
I know some of it. I haven't read the book, which it's on my very tall to be read pile. We have a TBR pile that my wife and I are just like, it's there's so much to read.
There's a ton of good material. I'm currently reading the Fiat standard for the second time. It's super. It's weird because I've said this to all you guys. I'm learning from the opposite directions because I'm in Bitcoin. It's great. I'm a Bitcoin standard. I've been on a Bitcoin standard for 6 years now. Freaking love it. Totally awesome. But because of Simply, I'm forced to cover Clown World. So I have to learn these things, and it absolutely blows my mind. That being said, the part from the fourth turning, one of the things that he mentioned was this idea of weak men create hard times, hard times create strong men create good times create weak men. And the last time we've had this type of scenario was World War II, right?
Mm-hmm.
Do you believe in that? And we actually at the very end of that conversation, we came to this like kind of conclusion, which was with Bitcoin, we finally have the tool to finally break that cycle, right? And it's that cycle of learning that you need to go back on a sound money, right? And that lesson takes sometimes 100 years, 150 years, right?
Yep.
And I think we're slowly starting to learn that lesson with all this pain. I think Bitcoiners already know, but I'm talking about the NPCs.
Right. And, if you hear Jeff Booth talk about it, he said there's just no choice. Like there's just no choice. This is the only direction it can go. All paths lead to Bitcoin. All paths lead to Bitcoin, and I agree. The fourth turning, I do believe, from what I know and what I've heard about it, I do believe that's where we are. And this echoes 1940 more than it echoes 70 by far. So it makes a lot of sense, and it's unfortunate, but here we are 80 years later. Here we are, and this experiment with fiats, this is all anybody's known that's alive. They've only known the fiat experiment, but that's not true in who's alive. But anybody in our little world here, like we've only known the fiat experiment. I mean, unless you were born in the 40s it's insanity. So, yeah.
Oh man. So James, and again, not financial advice, right? But if you were to anticipate what is going, Ron Paul has the theory of the crack up boom. If you were to anticipate I'm a big believer in the fact that I think a lot of things are going to happen in the next 5 to 10 years that are going to define lifetimes, right? Are we going to see a break? What is your expectation for the U.S. economy? Has the stock market hit a bottom? Do you believe we're going to go back down to the 2,500 levels? I've heard that about. So what are your thoughts on all that?
Well, I'm not going to make a prediction on the markets, but I can tell you that I do think that we go lower. I do think that there's more pain ahead of us. I do think that the markets are ahead of themselves, and they're the thing to watch is the bond markets. Bond markets know they're sniffing this out. The rates are going up, and that means that the market's going low. The stock market, the equity markets are going lower. That also means that there's risk that Bitcoin and gold go lower. So what do you do? Well, for me, I think it's prudent. This is me, and everybody's got a different investment profile. So you have to take this with a huge grain of salt. This is not for everybody. It depends on how old you are, how much you have in savings, what assets you have, what your income is. They're all huge inputs to all this. However, I think it's prudent to have some cash right now. I do. I think it's prudent to have some as you pick away, as this thing bottoms out, and you pick away, a little bit at a time, and you find those super high conviction investments that you believe that once we do come out on the other side of this next year, that will take off. Because once they do, you won't get a chance to buy them at these levels. They'll just be gone. So it will turn, I do believe we'll have, this kind of, we'll bump around these levels and go lower. And then we'll have like a hockey stick recovery out of it, and that's what I believe, because I think that once the Fed does make it clear that they're pausing or pivoting, it's game on, because everybody knows the money printer goes, and when the money printer goes, M2 expands, and when the MT money supply expands, things like stocks, Bitcoin, gold, they all go up and fast. And I think that Bitcoin's going to lead the way. So,
wow. Well, I'm really excited. And what surprises me though is the utmost confidence that you have when you say the Fed's going to pivot. Because if you take their whatever they say at face value, even though you totally shouldn't, because they went from there's going to be no inflation, modern monetary theory is a good thing, all this crap, and then they changed tune, said I'm wrong, and all that stuff. But you say it with confidence. Is it because they won't have a choice? Is it because okay?
It's a good look at the debt spiral. Look at the amount of debt we have on our balance sheet in the United States, the Treasury. They will bankrupt the Treasury. Like, people have talked about him doing the Volcker move and jacking up rates into 10, 15, 18%. You're out of your fucking mind if you think we're going to 15% on the Treasury. 10%. No way. 10%? That's $3 trillion a year of interest expense. No. Not unless you expect to have, 15 to 25% inflation for a while. I mean, no, I just don't see it happening. I think that they have very little choice. They're playing a game here, and they're trying to land a jumbo jet on a string, and they're not going to be able to. They're not. I do not believe that we can orchestrate a soft landing. It's going to be a little bit rocky here, but on the other side, money printer go burr.
So do you believe that this whole system, do you believe that Bitcoin will end central banking, or will it change central banking? Will central banking stay? Because you see it very popular. In fact, not only do you see the movement of end the Fed popular with Bitcoiners, you're starting to hear that movement more so than Bitcoin seep into mainstream consciousness as well. You're seeing a lot of predominant commentators and influential, people, specifically on Twitter, say things like "end the Fed." Do you think that's just a pipe dream?
Well, I mean, I know it's emotional, the Fed, but in reality, the Fed is reacting to everything. Okay, and you got a couple of clowns on there. A guy who doesn't understand the disclosure rules. Really, you're like in charge of monetary policy virtually for the entire fucking world. Okay, that you should probably understand those. Number one. Number two, Daly comes out and says, "Oh, inflation doesn't touch me." Yeah, of course it doesn't. Of course it doesn't on your salary. Like, wake up, people. So, but that's what that triggers people, and triggers me. It's infuriating. It's offensive, right? So, but that's emotional. And the reality is the Fed is just reactionary. They're reacting to everything the Treasury has done in expanding the money supply, handing out all the checks, and then the Fed's has to go in there and manipulate. Remember that. So I do give the Fed a hard time, and they deserve it, but they deserve it in this instance because they waited waited long to raise rates, way too long. And but they're reactionary. They've said it over and over again. So to answer your question, wouldn't that be lovely? But I don't have a high degree of confidence that our government will do the right thing there. I think that they want CBDCs and that the Fed will be in charge of them. That's what I think. So you better have some Bitcoin.
So do you believe that it's a scenario of People are going to choose Bitcoin. It is what it is, and they're going to have no choice but to go along with it.
Yeah, I think Bitcoin's here to stay. They're not going to have a choice. The people will speak. The people have spoken. They're going to continue to speak on this. And it's not going to be driven by the US. It's going to be driven by all the people who need it before us.
Yeah.
Remember that.
I've made that case.
We keep looking at this. Oh, like when am I going to make money in the market on Bitcoin? Like that's not the point. Just put it away. It's not a trade. It's not a trade for me. Just put it away. Just leave it there. Don't touch it.
It's savings. And I've actually said that many times. It's the developing country adopts it out of necessity, while the West adopts it because of speculative reasons. Anyways,
Correct.
James,
we're still speculating. Yep.
I know you have to run soon.
I do. I actually have an important business call. So
it's been a pleasure. Thank you so much for joining me on Simply Bitcoin IRL. Guys, sorry for the technical difficulties. It happens. James, where could people find you? Why don't you tell everybody about your newsletter?
Oh yeah. Thank you. And so you can find me on Twitter. I'm on there daily. I'm just at James Lavish. And I write the newsletter that's called The Informationist newsletter. It comes out every Sunday. It's I take one financial concept and simplify it for you. And so people seem to love it. It's got like over 10,000 subscribers to it in a short period of time. I just enjoy empowering people so they understand what the hell is going on around them, especially because we live in this completely opaque financial world, and that's not taught anywhere in schools. So I try to simplify it for anybody to understand, whether it's somebody who's been in finance or in a bank, or it's somebody who's been a stay-at-home mom and has had no financial education whatsoever, or it's, a fireman who doesn't, who knows? We're just not taught this stuff in school. So I try to help people with that. I love it. I love doing that. So.
Well, we really appreciate it. I definitely recommend it, guys. Check out James's newsletter. James, thank you so much. I'm going to roll it out. See you later. Right. See you at Pacific Bitcoin.
Absolutely. See you there.
Bye. Take care. Anyways, guys, that was another episode of Simply Bitcoin IRL. We will see you tomorrow back for the regular show at 12:15 p.m. Eastern Standard Time. I'm going to play the outro.
Which one's the best crypto asset? Well, Bitcoin's the best crypto asset. Okay. What's the second best? There is no second best.